Okay, welcome back. Jigar Mistry is now joining us, co-founder at Buoyant Capital. Jigar, pleasure speaking with you on the air. Thank you very much. It's been a while. Let's just kick it off with a very brief view on the market itself. Anything to worry, or it's all changasi, as they say? What is the near-term view, medium-term view?
Good afternoon, Prashant. Pleasure to speak to you as always. I think, whereas the sort of longest term view is that, US sort of FFTR at 5 quarter going to 575, 96 billion of QT, and markets at, 52-week high, something's got to give somewhere, right? But essentially, you look at the flows, they are through the roof. So I don't think people have paid attention that last week, as per EPFR, India got the highest ever flow since they've started tracking this data as EPFR. So I think the flow continues to remain extremely strong. If you look at a lot of, the broader market numbers, since I think 28th March, Nifty is up sort of 10%, but some 450 companies are up, over 5 billion INR in market cap are up 30% plus, some 150 are up 50% plus, 60 companies are up 70% plus. I think there has been a very strong broad-based rally. Obviously, when something as severe as this happens, you will likely see a scenario where there will be some pullbacks. There will be, businesses overshoot on either sides. But at every point in time, there are a few interesting businesses that do make sense. And that's how I think, one should ideally get positioned.
Right now, the street is very concerned about the prospects for Eicher Motors. Valuations are not cheap. The street has built in very high market share. Is there a risk that the market share of Eicher Motors gets eroded due to increasing competition from Bajaj, Triumph, and now Hero and Harley-Davidson? Because the pricing from Hero, Harley-Davidson is fairly attractive. So there would be some consumers who would be lured to brands like Harley-Davidson, and you need to pay only 15-20% more.
Good afternoon, Rima. I think, yes, you essentially look at the price point. I've been told, that it's a very attractive price point. But you go back and track. One bigger point to note in terms of timing is extremely crucial because RE engines, again, I'm told, over the 5 years have, had a very dramatic improvement. And Bernelli from Italy or Harley-Davidson today sort of have to an extent missed the mark in terms of, sizing India up and the time they have taken to get the product launched. Even Hero sort of Highness, which got released, if you talk to people on the ground, I'm not getting the sense that the impact is as meaningful as, the market fears around these launches. The point, however, with a two-wheeler, recovery and rally is that there is a difference between the underlying profit growth and the sort of embedded value that gets built in because of the likely disruption. And if you look at most of these two-wheeler share prices, over the past 3 years or so, the share price sort of increase has been much higher than the underlying profit growth. And part of this embedded value, which is sort of created because of a potential EV-led disruption, can actually, take the stocks on either sides. So, as such, we don't really own any of these names, given that the level of this size of disruption has not been done with any living consumer discretionary. But I think, on days like this, it does feel like that the market overreacts on the possible fear.
Absolutely. Point taken, Jigar. Speaking to people on the ground, have you spoken to people on bikes? That's a real question. People on bikes on road. Jigar, let's talk about financials, right? And that's an area where I think you have some ideas. NBFCs, for example, I think public sector banks, you've got a couple of picks. Smaller banks is somewhere you focused on. Just kind of run us through the fundamental argument there and what do you like?
Right, Prashant. So I think we look at the banking era as two, separate sort of distinct eras, pre-2015 and post-2015. And once a lot of corporate debt started slipping, in the annual quarterly quality review initiated by the erstwhile governor, I think the banking balance sheets have been clean. I think that is now a consensus sort of belief. Within that, you look at 3 or 4 cycles to play through. So credit growth cycle continues to remain extremely strong. We're still not yet talking about the $280 billion short-term maturities, which are currently priced in Forex. And with the ultra-low repo minus FFTR differential, you can likely see some of that being refinanced from India. So that's an additional growth lever, but we are not yet talking about that. But the latest data that we saw grew at 15%. So that's an even keel for everybody. The second cycle is the NIM cycle. And in a rising interest rate scenario, theoretically, the NIMs expand. And they do, obviously because banks reprice their assets much faster than liabilities. But there is a timing differential, right? So clearly, private sector banks are much faster to reprice their assets vis-a-vis their loans. PSU banks follow. And therefore, sort of when, your interest rates peak out and flatten, you see sort of NIMs of private sector banks compress much faster than PSU banks. I think there is some amount of, play out there. The third is the credit cost cycle, and that's benign across the board. But increasingly in the MFI space, you are now looking at collection efficiencies coming back to pre-COVID level. And that's a space which is getting interesting. And lastly, there is a valuation cycle. So what we did with, ICICI or SBI 3 years back, a lot of investors are now playing it very clearly through a lot of PSU bank vis-a-vis SBI. And within that space, if all things being equal, you tend to get a faster growing bank on a lower base. So a lot of these smaller banks with, everything else, the credit cost being fair, valuations are cheaper, and therefore you can see a much stronger growth coming through with a lot of these sort of smaller private sector banks, which make them a very interesting place, Prashant.
You find the home textile segment also interesting. There are concerns about demand. So can you tell us the narrative behind home textiles and which companies in particular?
See, I think you're playing a possible deceleration in demand across. Then there are a few ways you can look at it, right? So if you're looking at the compression of the global cost curve, not just cotton or agri-commodity, but commodities across the board, aluminum, steel, oil. And there you get a lot of interesting opportunities. So you look at the cost curve compressing and the potential of the final product pricing not compressing as fast. So last month we did discuss something like the cement, which can, hold very well there. Very clearly, home textiles and a lot of these companies with the softening cotton prices, they are not really pushing. The demand fall is not, commensurate with the fall in cost and the expansion in margin that you see. And a lot of these businesses, could be Indocount, Welspun India, Himmat Singha is not so much home textiles, but clearly all of these companies have had a very strong sort of last 3 months or so. Similar in the pack, I think now staples do make the cut. So for the largest part, I think for the past 3 years or so, they have had to take a price cut in between, and therefore you've seen a very subdued sort of returns from a lot of these businesses. But I think you are going to see much sort of softer palm oil prices, much softer commodity prices, packaging prices, and most of these staple businesses have been ignored in the small/mid-cap rally over the past 3 months. And that might not be a very bad space, one can find themselves in.
All right, Jigar, good conversation as always. Thank you very much for joining us and running us through all of that, what you like, and themes that one should look at. Thank you once again. 20 points on the Nifty, 19,345 is where we are at. We'll take a very quick break here. On the other side, more coming up on markets and, of course, specific stocks.